Welcome to the March 20th, 2023 Advanced Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, and what a week it was. Shockwaves through the financial markets and the banking system. The title of this week's program, Banking Crisis Averted or Not? I'm going to cover the key players, the key parts, and of course, the Federal Reserve and what they're doing about it along with the FDIC. Important developments change the picture, and I'm going to cover the facts behind it. So this is the Regional Bank Index, and you can see with the failure of Silicon Valley Bank and Signature Bank, Silicon Valley being the leader in venture capital, clean technology, and startups. Well, they'd made a lot of loans to startups. That really wasn't a problem yet, but the companies were burning cash, deposits were going down, and then a panic set off, of course, last week, week before last. So last week opened with the failure of Silicon Valley Bank and Signature Bank, both taken over by the FDIC. Now, first thing, is there going to be a big run on the banks? Well, the Federal Reserve and the FDIC stepped in to make all the depositors whole above the FDIC limit. This could mean that the FDIC limit is a thing of the past because they said they would extend that facility as needed. Well, that says essentially the Fed started providing liquidity. Listen closely. The Fed went from tightening to providing liquidity. They went from tight to loose. The whole Federal Reserve posture has changed regardless of next week's rate increase, which could still happen. However, the posture has changed and the bond market has completely changed. So, the extension of the deposit insurance as needed potentially to any other banks in trouble was the first step in averting a contagion. Now, here we've got the regional banks. You can see the drop from 65 to 45 on this index, a total decline of 37% over the year. They sold all the regional banks all week long. You can see a little bounce here with the deposit insurance discussion. Now we go to First Republic. They got a $30 billion lifeline from JP Morgan, who did it in 1907, by the way, and averted a panic there, and a host of other banks. Now, I'm sure they got some very generous concessions as competitors for providing those deposits to First Republic Bank. And you can see First Republic going from a lofty 150. They were a lot of venture capital, and venture capital is the flashpoint. It means private equity, the values of all private equities are getting marked down, and if you have private equity, you carry it at cost until you hear otherwise. Well, you just heard otherwise, because venture capital, the capital has dried up. And money-losing companies, there's no mercy. We've shown you that in the past. Boom. It went from 150 to as low as 1750 this week, and then a rebound. Whether First Republic makes it or not, well, that's a key question. But they're the third bank in the series. And a lot of these had crypto as well as venture capital crypto. The two were related for many banks. These are the regional banks in Texas. Texas Capital, and you can see the declines and the sell-offs and a small rebound here. Comerica's down about 34% so far this year. Cullen/Frost down about 25%. And Texas Capital Bank being down about 9%, the strongest of the group. But the regional banks were the flashpoint of the crisis, and the FDIC, Federal Reserve backstop, potentially extending deposit insurance as needed. There's a big difference in the Texas banks, though. Who are their customers? Generally not venture capital. These are cash-rich energy clients in many cases. So Texas banks are a different animal, and that may provide more resiliency or even an opportunity. Remember, it's not a recommendation for your portfolio until you get a plan from McGowan Group Wealth Management, which you can arrange at networthradio.com. Just send us a quick message. We'll be on it like a bird on a June bug. You can have your brainstorming session in the midst of the crisis. The power of reinvestment was going to be the title of today's program. The power of reinvestment, when you get these flashpoints of crisis, if you've got stuff that pays great cash flow, like well-managed global high yield funds, energy investments, medical dividends, and other companies, then you can reinvest those dividends. And that gains advantage. It gives you more future income as you go forward. Now, so the price movement can work for you if you handle it correctly. And we picked up a few bargains this week in some blue chips at the flashpoint of Wednesday. So here, what have we got? We got interest rates. The posture has changed from fire to ice. What do I mean? Inflation to deflation. Banking crisis generally means deflation, depression, 1929. Those are the first thoughts people have, or 2008. Well, this one is different, but the Federal Reserve posture and the Treasury market have totally changed. You could see this peak when the Fed was doing their magical mystery tour, where all the Fed governors and presidents going around saying, we'll take rates as high as we need to control inflation. That's not the big worry anymore, and that is evidenced by their reversal in posture. They raised the rates so high they broke something. Now, in the long play program at networthradio.com, we cover the change in balance sheet that occurred March 9th of 2009, which was the exact low of the Dow. What did they change? Mark to market for the loans and bonds to you can hold it to maturity. Two different parts of the balance sheet. Well, why is this important? Well, Silicon Valley Bank bought a bunch of mortgages with their extra deposit money, and they bought treasuries too. And the value was down because you could see the rates went up. So those bonds and loans were worth less. Who wants to buy a 3% mortgage bond as an investment when the new rate is 6? No, you got to mark it down. That's what happened to $10 billion in capital for Silicon Valley Bank. Now, what happened here? Boom. We went from a T-bill rate that actually got as high as 5.25 on the 6-month T-bill, betting the Fed would go higher and faster. Boom, you went all the way down to 4.4 on the T-bill. The 10-year Treasury was above 4%. Just a few days ago, and it went all the way to 3.4, 0.6% less. Why would institutions buy that? One is, oh, there's going to be a severe recession. Two, the Federal Reserve by next year is projected to be lower. In other words, inflation may not be the big worry anymore. In fact, the Treasury curve going back to normal. What would that be? Overnight bank lending rate 2 or 3%, base rate for capital, and Treasuries paying 3 to 4%. That's a more normal market. It's being projected right here for 2024. I'm going to show you some other things about 2024. You want to get ready. This is the Dow, by the way, descending all the way this week to really 31,800 was kind of the equilibrium point in these days. And you could see that's really the worst level since November of last year, and very similar to different points. For 15 months, the Federal Reserve has tortured the markets with relentless interest rate increases, not telling us how high they're going to go or when they're going to stop. Well, it could have stopped based on the evidence I just showed you, and I have further evidence. Producer prices. Producer prices are inflation for companies. Then they pass along, if they can, those price increases, or their profits take a hit. And both of those things happened. Price of eggs, by the way, last month went down nearly 7%. So that's deflation. at least on egg prices. I guess instead of paying $10 a carton, you're going to pay $9.30. Ooh, that's huge. Okay, so at least it reversed. Now, look at this. You got minus 0.1% on producer prices. Deflation. And look at producer prices since June. Your inflation rate for 8 months has been sitting at less than 2%. That's incredible. The Fed's using the trailing 12 months. What's about to happen? Well, the big months, that's June, they're going to drop off over the next few months. That's going to be significant. Then something else is projected to happen. All right, pay attention here. S&P 500, 500 blue chip companies, and how much money do they make? This is a graph of how much money they make starting in 2018. After-tax profits per quarter for the S&P 500. Look at this. We didn't get any significant increase. In fact, we had record earnings in 2018, and they really didn't go up significantly, although the market recovered from that Fed tightening, by the way. What happened, and continued on up from there. There's the pandemic. Has reached a low of $10 or $15. The two different lines, there's operating earnings and reported earnings in case you have to take a write-off. Here, there's the recovery to record profits, $55 per S&P unit here. Well, we have descended. This quarter says back to 40 bucks. And if we said, okay, what does that look like going forward? This is significant. The projections on the S&P 500 go from 40 to over 60 by the end of 2024. If that's true, this is a great opportunity to build great assets into the portfolio and to benefit as we get towards the second half of the year. So, networthradio.com, you can contact us there. Be sure to subscribe and like it, because here in the midst of the banking crisis, because you're subscribed, you get the update that says what happened this week and what does it mean going forward. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.